Delighted that Bruegel is hosting with us. My name is Jonathan Charles. I'm from the European Bank for Reconstruction and Development. I'm the Managing Director for Communications. And over the next hour or so, we're going to be examining sustainable growth in transition countries based on this new report, the EBRD's Transition Report, which has been produced by the Office of the Chief Economist, and Sustaining Growth is that title there. And we're going to look at some of the impediments to growth, some of the potential ways out of the problems, and discussing the delights of the middle income trap. After we've had a few words here, of course, you'll have a chance to ask your questions, and we really hope you will. Let me introduce the people you see around me. First of all, on my far right, but not politically, is Sergei Guriev. He is Chief Economist of the EBRD. He'll be giving a presentation initially on the report before we move into a panel discussion. Next to him is Lucio Vinhas de Souza. He's team leader at the European Political Strategy Centre. Next to me is Deborah Rivoltella from the European Investment Bank, where she is the chief economist, or director of economics as they call it there, I think. And on the far left, again, I'm sure not politically, we have Jacques Darvash, senior fellow here at Bruegel. So we'll be discussing all of this, but first of all, let's set out exactly the path of that leads to the discussion, the path, the line, the thread that runs through the transition report. Sergei, over to you.
Thank you very much, Jonathan. It's great to be back here. I had the privilege to serve on scientific advisory board of Bruegel for a few years, and I'm very happy to see Bruegel developing as successfully as it does. So indeed, as Jonathan said, this is our annual transition report on, is the sound is okay?
Yes.
Yeah, okay. It's our annual transition report, and last year we were talking about inclusion, equality of opportunity, and basically our argument was if you have reforms and growth, but the growth is not inclusive, so not everybody is sharing the benefits of the growth. Such a growth is not sustainable politically. It's not politically legitimate. So if you want sustainable growth, you need inclusion. On the other hand, this year we thought even if you have inclusion but you don't have growth, that's not good enough either, because if you have inclusion without growth, you actually have zero-sum game, redistribution of a pie of the fixed size, which of course leads to conflict. And in that sense, we need to focus on growth. And the problem is that growth in our region, in our countries of operation is not actually recovering fast after the crisis. So this is the chart which summarizes this challenge. So basically in this chart we show the growth in our countries of operation and also in similar countries. So for each country in our region we built what's called synthetic control panels. So we look for countries with the same level of development and same size, and we look at growth rates of those countries. And here you see that before the crisis, our countries were outperforming the comparators. Those green bars show the positive outperformance gap that our countries had before the crisis. After the crisis, growth slowed down everywhere, but especially in our countries. So whenever we hear about middle income trap or post-crisis growth slowdown, it is especially strong in our countries. Now, by now, the gap is not too large, and still there is a gap in the sense that the slowdown in our countries has been stronger than in other countries. And if you add up this gap in the recent years, the accumulated output underperformance is something like 9 percentage points, which is, of course, a lot. So in order to motivate the discussion of middle income trap, I would just say that this slowdown is also coming up in our region when our countries are now at middle level of income. And I will talk about the fact that middle income trap is not something universally valid and relevant, but it is actually a very useful concept to think about. And one of the issues here, which you can see on this chart, is that when you look at TFP growth, productivity growth, you do have this middle income range at which many countries see slowdown in productivity growth, and in some cases actually negative productivity growth. And our countries are moving or already are in this range. And Therefore, productivity growth challenge is part of the focuses of this part of the study in this report. Now, another dimension of middle income challenge is what we call environmental Kuznets curve. And basically, the story is that poor countries are relatively environmentally friendly because they don't have polluting industries. Richer countries already moved on and no longer have the majority of their economy concentrated in polluting industries. They're in human capital intensive services rather than industry. So it is the middle income countries that pollute more than poorer or richer counterparts. And in that sense, whenever we talk about middle income, we should also think about the green component of this issue. And this is actually especially true for our countries of operation. If you look at what our countries did in terms of emissions per unit of GDP, there is a remarkable success of the last 25 years in decreasing emissions per dollar of GDP. But still, we outperform competitor countries in terms of emissions. And the gap is something like 20 or 25%, depending on how you measure. It's better than twofold gap that used to be the case 25 years ago, but still, there is a gap. Now, if you look at per capita emission, then things are not looking as well. The progress is actually limited. Taken together, these two charts kind of give you also an optimistic message that our countries managed to grow by adding value added, by adding sectors which are not polluting. But yet, we are still not there. We are still outperforming the competitors. And I should say competitors are also not doing great. So I will talk about 5 parts of this report very briefly. I'm very happy that the report has arrived here, and you're welcome to read the report and ask questions about it. But I'll talk briefly about 5 issues. And let me first start indeed with the middle income trap challenge. Now, this concept is something like 10 years old, brought up in a paper by 2 World Bank economists who suggested that when countries reach middle income level, they stop growing. Now, conceptually, you can identify those challenges in many countries. Econometrically, it's very hard to find a threshold which says when you reach 40% of US level or 60% of US level, that's when you slow down. Or when you reach $10,000 per capita, $15,000 per capita, that's when you slow down. This is not the case. We don't have a threshold. And we just have this declining growth rates as you get closer to the frontier, but this is normal. This is what growth theory would tell you. You have what's called conditional convergence. So it's normal to slow down when you get closer to the frontier. It's harder to grow when you become richer. Now, the problem is that there is a conceptual issue here that you need a new model of growth when you move from middle income to high income. When you move from low income to middle income, the growth model is driven by investment in physical capital, investment in basic education. It's the industrialization model. Most of our countries have already done that. And so for them, the challenge is actually to move from the model of growth built on investment to the model of growth built on innovation. And for that, of course, they need different sets of institutions. If I have time, I'll talk about success stories. One of them is, of course, Korea. And in Korea, there was a lot of talk that Korea needs a new model, not based on investment, not based on big business groups. And the legitimacy of the previous model was broken in 1998. And Korea, well, this is a little bit of an urban legend, but it is correlated with the data. But basically, that model was broken, and Korea moved on to post-industrial, knowledge-based, innovation-based model. Our countries are still in this area where they need to do more. I'll show you some graphs confirming that they're still not done and need to do more. Anyway, so when we think about institutions which are important for innovation-based, human capital-based, knowledge-based growth, of course, we are talking about institutions supporting financial development, institutions which provide competitive markets that provide incentives for innovation, institutions that integrate companies in the global economy, and so on. So just to motivate that we need a new growth model. Let me show you the decomposition of growth rates in our countries before and after the crisis. So in the decade before the crisis, our countries did very well, and here you can see that they did outperform the competitors as well as most other emerging regions. But most excitingly, in our countries, this performance was driven by total factor productivity. Now, our countries emerged of communist past with urbanized society, educated population, and quite a bit of industrial capital. So in that sense, the challenge was not to invest more. The challenge was to put those factors together in a more efficient way. And that's exactly what they did. And majority of growth in the decade before the crisis is about total factor productivity, efficiency of using the factors. Now, if we scroll forward to the decade after the crisis, well, decade is not done yet, but you see that actually that model of growth is gone. Total factor productivity does not contribute positively to growth anymore. If anything, it contributes negatively, which explains underperformance relative to competitors, relative to other emerging markets. And most of growth now is coming from capital investment, but even capital investment is actually below capital investment in competitors and in other countries. So this is the challenge. We need to restart productivity growth, and I'll talk about this, and we need to restart capital investment, which is still lagging behind. So this is just going country by country. We show which countries underperform by how much, and we end up with a big number, which is something like €500 billion in the last few years has been the gap in investment compared relative to similar emerging markets. So it's a huge number. And 40% of that is in infrastructure, but the rest is in other kinds of capital. Now, I already said a few things about Korea, just to say that Korea has done particularly well in moving beyond the middle income trap and managing to have built an economy based on innovation. And if I have time, I'll talk more about this, but this is, if you want a stellar example of success, this is one of those. Now, what we do in this report, we actually go around the world and we look at what other countries did when they outperformed others and how those outperformed episodes ended up. And what are the drivers that increase or decrease the probability of underperformance or overperformance relative to competitor countries. And basically, there is no rocket science. We talk about the very same factors that emerge from growth regressions, investment, including investment in infrastructure, institutions, human capital, and so on. Of course, people would say that investment is endogenous to institutions. So I'm not showing this chart here, but if you try to control for this indigeneity of investment that responds to good institutions, that of course contribution of institutions would be even higher. And that is one of the challenges, and that's why transition report in 2 years will be devoted to governance, and this is when we use data from our BEPS survey run together with the World Bank, and this time with the European Investment Bank. So let me now open up this black box of productivity at the firm level. So what we start with ask a question: to what extent productivity in our region has been driven by innovation? And the answer is not really. So in the previous survey of firms, we actually asked a question: do you do innovation, and what kind of innovation do you do? And then we codified the answers and actually went through the text and said, no, sorry, a new label for the vodka bottle is not something that we consider a globally path-breaking innovation. It's good for marketing, but it's not really global breakthrough. And we found out that less than 1% of firms in our countries do globally path-breaking innovation. And in that sense, our countries have done really well. But if you look at various measures of innovation, you see that our growth was innovation light. Most of the growth was about adaptation, adoption of new technology developed somewhere else, investing in factories that use this technology, but not in new technology invented at home. And you see that it's not just Korea that did better, but also China and Turkey, which is now our country. But still, compared to post-communist countries, there are other countries which grew GDP per capita and created some innovation, at least in some industries. So what we do here, we look at firm-level data. We use both World Input-Output database, but also CompNet. This is the partnership between various European institutions, including ECB, but also us, where we get together with statistical agencies in several countries, and then they don't give us firm-level data, the censuses of firms, but they are agree to run our programs on those data sets. So this is quite a detailed study of firm-level data. And so let me give you a number of takeaways from this study. Most of that is in the report, but I'll just show you a few graphs. So one thing which we discover is in our countries, relative to the Western Europe, we have many more small firms. And these firms, unfortunately, are much less productive than larger firms in our countries. Now, in all countries, larger firms are more productive. So size matters. But in our countries, size matters even more. So if you look at this chart, you see that the productivity premium of size in Western Europe is something like 40%. In our countries, something like 70%. So then what we find, we do find this middle income trap in productivity growth. So convergence in terms of productivity is about copying somebody else's technology and growing at the same, growing at a faster rate than the leader. So if we take US as a leader, you would think that if you are below US level, then your productivity growth rate should be above 3%, which happens to be TFP growth in those industries that we study. But that is only the case if you're very far from the frontier. And it turns out that when you reach 60 or 70% of US productivity level, you stop converging. You actually grow slower than US industries. And now the question is how to address this issue. And we do have many results, but let me tell you a couple of things which we think are especially important for our industries. And one of them is integration in the global economy. So if you look at companies which are less integrated in the global economy, use fewer imported inputs, and export less, these are the companies that suffer from this convergence challenge. If you look at the most open industries, they keep converging, they keep outperforming the US companies as long as they're still not at the frontier. So openness really matters. And integration in global value chains also matters. It's the same result here. Now, another thing which I want to mention, I think this is very important when we, again, put this idea in the perspective of inclusive growth, is that in Europe and in emerging Europe in particular, productivity growth creates jobs. This is different from big tech companies in Silicon Valley, some of which are extremely productive and very big, but jobs light. In our case, investment in productivity results in flow of labor from less productive firms to more productive firms, and the higher productivity you have, the more likely you are to see higher rate of job creation, which is good news. And in general, it means markets work. And that is also a reason for optimism, especially talking about more open firms and industries. This phenomenon is driven by industries and firms which are not only productive, but also integrated in the international economy. And so our countries still are beneficiaries of globalization, whatever certain populist politicians say. So let me now talk about one other source of growth, which is infrastructure. As I mentioned, in our countries, we have a capital investment gap, and almost half of this gap is coming from infrastructure. And we go country by country and identify infrastructure gaps, and basically we see that 10 years ago, our region was kind of at the level of China. Now it's far behind China, not even speaking about Western countries. And we can actually identify how much money it takes to keep infrastructure at the same level as today. Infrastructure has a tendency of falling apart, as we can see in some of our countries. We can also see how much it takes to grow infrastructure to maintain the growth rates we are observing today. And finally, we can see how much money it takes to catch up with the West in terms of level and quality of infrastructure. And basically, if you add up all these amounts, you end up with a 2 trillion euros number. Half of that, roughly half of that, is just to keep growth in place. And another half is to catch up with the West. So these are astronomical numbers. So challenges are big. But there is also a positive message. So we looked at our biggest country of operation in terms of volume of business, Turkey. And so in Turkey, the government undertook a major roads upgrade project. Basically, about a quarter of the roads were turned from 1 lane each way to 2 lane each way divided expressway. And you see that the connectivity especially grew in the east, which in Turkey is less developed region. So usually people say, okay, you build roads, and unfortunately that happens in some EU member countries. You build roads to where people don't live. Or you build roads where there are no jobs and people leave those places, going to where jobs are. So what happened in Turkey? So what we do here, we use a very sophisticated identification strategy. So we look at all pairs of origin and destination, and we have data on firms located in each place and trade between those firms. And so for each pair of origin and destination, we actually see how much this new investment has reduced travel time. And here you see the 5 quintiles. So in the bottom 20% of time savings of the pairs of origin and destination savings are half an hour in total driving time, truck driving time. And in the top 20% of pairs, origin-destination, we have savings of something like 5 or 6 hours. So it's a major improvement in connectivity. So the next question is, what has happened? And in the report, we show that the more time savings you have between point A and point B, the more trade there is between firms located in A and B. And I should say sometimes it's not about building a road between A and B. It's about building a road between C and D. But even if you build a road between C and D, connectivity between A and B may also go up, of course. And we show that jobs are also created. So here you have the difference in change in employment between top 20% of destinations in terms of time savings, next 20% and so on, and we see that the top 40% of regions or regions that benefited from the upgrades actually have seen major increase in job creation. So it's not like people left remote regions to move to the West. It's more like trade emerged and jobs were created. And I think this is a very, very optimistic region. Now let me come to the 4th chapter, which looks at the green growth. And these are the graphs I showed you already. So one of the challenges is that if you are stuck in the middle income trap, you're also stuck in the high pollution trap. So the question is what you do about this. And as I said, in our countries, this challenge is especially important. And one of the reasons for this is our region, especially countries which have a lot of fossil fuel in their energy mix, are also champions in terms of energy subsidies. And I'm not showing the energy mix here, it's in the report, but basically we have countries of operations where fossil fuels account for more than 90% of energy mix. On average, we have 80. And in Central and Eastern, Central Europe and Baltics, we have 70. Still, it's quite a challenge to go for greener growth. And when we look at different kinds of fossil fuel subsidies, we also ask a question. Okay, what kind of incentives subsidies create for firms? And again, in our survey of firms, we also have a measurement of quality of management. So we run this Bloom-Van Reenen questionnaire of quality of managing the company. And then we ask a question, if your company is running better than another company, what kind of energy efficiency investment do you undertake if you have energy subsidies? And the answer is, if incentives are wrong, better managed companies do wrong things. And this is normal. This is how markets work. And that also creates the rationale for, not for destroying well-managed companies, but of course for removing energy subsidies. So another thing which I'll also show you, and there is much more in the report about green revenues, climate index. We have actually 8 boxes in this chapter, looking at various aspects of green growth in our region. But I would like just to show you this chart, which is related to the data set collected by FTSE and Russell, so by London Stock Exchange, where for each firm listed in London Stock Exchange which is interested in this measure, they calculate the share of green revenues. And green revenues also include blue revenues, if you know what I'm talking about. So water is also good for green revenues in this case. So, and then we look at this data, and we run a regression with country fixed effects, with industry fixed effects. So we look at similar firms with and without green revenues, or with more than 50% of green revenues and less than 50% green revenues. And we ask a question, what is different between those firms as they develop more green revenues over time? And the answer is, well, greener firms are younger, they're still smaller, they're growing faster, and they're less profitable per unit of market capitalization. You would say this is bad news, but I would actually see that as positive news, which suggests that investors are happy to pay more for greener firms, even though current profits are still not high. That means that markets price in the future profits coming up from green revenues because policies are probably going to improve, at least markets think so. So let me actually skip this slide and say that when we think about new growth models, I think, again, we don't have easy answers. These solutions are something that we've known before as well, and the solutions come from better institutions, better governance, pro-competitive policies, integration in the global economy, removing distortionary energy subsidies, and in that sense, it's not, and of course, investing in sustainable infrastructure. A lot of people would say some of our countries are corrupt, not well run, but we do have major successes where infrastructure brings trade, connectivity, and jobs. So I wouldn't say that things are that hopeless. And in order to demonstrate that, we also include the chapter on structural reforms, the 5th chapter of Transition Report, where for the first time in the history of EBRD, we moved to a new 6-dimensional structure. We actually used to have 7-dimensional structure, but now all the 7 dimensions are collapsed in the first dimension, which is competitiveness. We now revisited our transition concept. So the definition of success of EBRD is now sustainable market economy, which has to have 6 transition qualities, as we call them. Not just competitive markets, but also well-governed economy and well-governed companies. Also green economy, something that I've already talked about. Inclusive economy, this is what we discussed in our last year's transition report. The argument is, even if you build competitive markets, if these markets don't deliver for majority of citizens, pro-market reforms will be unpopular, rejected, and reversed. We also believe in resilience, and resilience for us currently is measured as 2-dimensional thing, financial resilience. So whenever you have financial crisis over the ocean or next to you, next door to you, your financial system doesn't collapse. Also, energy security. So if you have volatility of energy prices, your economy still goes through. And integration, something that I've already talked about, within country integration and cross-border integration. And so what we do now with this, we measure those indicators. Here you can see 14 indicators actually, 2 per quality and 3 for green and 3 for inclusive. And for each quality we calculate what we call the frontier. And here we see the spider chart for advanced economies comparators. In this case, that would be Sweden, Germany, US. and our regions. And we do it actually country by country. In the report, you can see the scores for each country, and you see how much we still need to do in our regions. The good news is when we look at the reforms that are being implemented this particular year, things are getting better than last year and pretty much picking up from the last few years. And this kind of is a basis for optimism. In the report, we actually have country pages which are not in the paper copy, which are online. We are a green bank, after all. But we have examples of successful reforms in every country. As you can see in this chart, some countries have gone backwards, very few, but still, this 10% of reforms are actually anti-reforms. For example, in governance, some of our countries exited EITI, Extraction Industry Transparency Initiative, and that's unfortunate, and that's what we rate as a negative development. But we have progress on inclusion, we have progress on governance, we have progress on green around the countries, and I'm happy to talk about those examples. And overall, there are two reasons why this is happening. One is that after certain electoral setbacks in various countries, people in continental Europe and in our countries of operation understand that we need more sustainable market economic models. Another reason is much simpler, which is growth is still faster than it was just a year or 2 years ago. And in that sense, it's probably easier to do reforms. And with the European economy growing faster, our economies are also feeling more space, more fiscal space in particular, for conducting reforms. So let me stop here, and I'll be happy to take your questions afterwards. Yeah.
Okay, thank you very much indeed. Typically rich outline there from Sergey of what's in this report. Let's try and pick some of the bits out of it. Jean, let me start with you. You know, a few years ago we had stuck in transition. I guess this is stuck in middle income track, but with some opportunities to get out. I mean, how would you dissect that?
Yeah. First of all, let me congratulate Sergey and his team for this, once again, a very nice and very comprehensive and excellent report. And what I especially like in your reports, that in each year you always find something, a very nice way to deliver a very important and useful message. Maybe, for example, your report some years ago on governance, maybe that also might have a role that we are seeing more beneficial reports. I mean, who knows? So again, the first word is congratulations. Now, I would like to discuss three issues, basically. In fact, raise some thoughts. One on the middle income trap. The second on what to conclude on the so-called Washington consensus. And the third one on demographics, labor markets, labor shortages, and whether that could be a factor prohibiting growth in the region. So let me start with the middle income trap. What I think would be very interesting to know is which I have to say, one aspect I missed from the report, is the large diversity within your countries of operation, because you have a couple of European Union countries, you have candidate countries, you have Russia and other countries which are really, really different. And especially if you look at the slowdown, I think the slowdown impacted these countries differently. I mean, in Europe, we see, for example, that some countries in Poland, I mean, they are really doing well. There was no recession at all. If you look at Croatia, for example, which suffered and had a very, very prolonged period. So I think that even within the region, there are better examples and worse examples, and a better understanding of why this is the case. Is it just some countries has much more foreign currency loans and they suffered more and the Swiss franc appreciated, or some countries have weaker economic and political institutions. So I think that would be one aspect to discuss. Another which I find very, very interesting in your report is the role of small and medium-sized enterprises. I think the chart you put here was really, really telling, as you well emphasize that size matters everywhere, but in Central and Eastern Europe, size matters even more. So smaller companies relative to larger companies are less efficient, less productive. And again, understanding what's behind that, I think is really, really crucial. A further aspect I think would be interesting to look at is a comparison with Southern Europe. Southern Europe, I mean, let's say Spain, Portugal, Italy, and Greece, at least some of these countries were converging relatively fast in the pre-crisis period. And then came the major crash which these countries suffered. And well, now we see very good signals in Spain, some in Portugal. I mean, Lucio certainly knows about that. But in Italy, for example, I think the situation is not looking good. And again, if you look at these countries, they also have a very large share of small and medium-sized enterprises. And so why is it that Central Eastern Europe and your operations of countries are doing comparatively better than, let's say, Italy, even though I think the SME problem in Italy could be as severe or perhaps even more as in your countries of operation. And the last point on the middle income trap is related to the measurement of TFP slowdown. So we always measure TFP as a residual, and we not always know what enters into this residual. But we know that cyclical factors can influence it a lot. I mean, for example, when a country faces a major economic contraction, then certainly the capital remains there, so capital is not cut. Sometimes labor hoarding, people not laid off. So we could see some cyclical variations also in TFP. So I think your chart, which shows that in 2008-14 period, actually TFP growth was negative on average across the region. I think at least partly that could be related to cyclical. So what I think useful to look at what is a more structural component of TFP development. Now, the second issue is the Washington consensus, which basically says that just liberalize, and everything will be fine. Now, you also have a number of comments on China in your report, which I find very, very useful. And we know that, for example, China did its transition under very, very closed capital accounts. Now, certainly it's going to more and more market liberalization, but still a very large share of the state. So I think a very important question is what to conclude on all of these openness issues. I find your findings very convincing when you show that more openness helps. Participation in global value chain helps. It was also, I think, came out from this report very, very nicely. But again, if I look at even how the IMF changes its view on the Washington consensus and on openness to various flows of capital, we see a major reassessment. So I would just interested to hear your views, how much openness is helping. Now, certainly, countries which are in the European Union, they have no choice. Of course, they have ratified, they are members of the EU, ratified the EU treaty and so on. But what advice can you give to let's say, countries further to the east, which still maintain relatively tight controls? Should they rush and try to open their capital accounts even more, or they should take a more cautious approach to that? And the third issue, which I really find alarming, if I can say, is the labor market and demographic developments in the countries. Now, I mostly know those countries which are in the EU, but if you look at recent surveys, business surveys, asking what are the most important factors which prohibit the expansion of your activities, then almost all companies say labor. We also see increased immigration from these countries to Western Europe. So basically, many bright people leave these countries. We're also having a report on migration, and for example, found that if you look at the total stock of, let's say, tertiary educated people in the European Union members of your countries of operation, then 15% of that are already out of the country. While from the low-skilled people, only about 5 or 6% of them out. So that many high-skilled people are leaving. At the same time, what we see is that the demographics of these countries are really awful, much worse than in Western Europe. So again, if let's say the emigration of the high-skilled is continuing, demographic is very, very weak, then it can be really an important factor hindering economic growth. And on this point, let me come back to in my very last word, to a paper of Barry Eichengreen on the middle income trap that you also cited in your paper. Basically, what he did with his colleagues is that they looked at, basically took a global assessment of how middle income trap, where is it, what are the causes, and so on. And they identified 2 crucial factors which can help to limit that. And one was education, and the second one was technology upgrade. So again, if these countries try to do both, I mean, they are educate, but labor votes with their vote and leaves, then certainly that wouldn't help. One issue could help certainly is increasing wages, and we already see in a number of countries very rapid wage increases. But again, that can have very diverse effects, because big companies, like if a big multinational enters these countries, probably they can cope with higher wages. Probably their profit rate will go down. But many SMEs will not be able to cope with that. So again, this labor emigration, educational problems, increasing wages, coupled with very unfavorable demographics, can indeed have a major negative impact on the long-term impact of these countries, and in fact can contribute that these countries have a higher chance in trapping in middle income. So thank you.
Thank you very much indeed. So challenges and opportunities, Deborah, but interestingly enough, you set, Jean, the backdrop of the Washington consensus fracture almost, and whether that therefore makes the path out for these countries a lot more complex to navigate, because the solutions and finding solutions is a lot more complex.
So let me start as you did, congratulating Sergey for the excellent, and the team for the excellent report. As usual, the transition report is always like this.
Try that.
Okay.
As well.
Okay, so we are interacting. Okay. Should work. Yep. Okay, so I have the opportunity to congratulate a second time with Sergey and the team and the team for the excellent report. And as usual, I think the transition report is something that everybody is waiting to know what to think about the region. So it's very nice to have again such a good report. I liked very much, actually, the concluding slide that you had. That was not the concluding one, because then you had 3, 4 more, but the one that was called conclusions. And in terms of the policy message that you are giving, and I just repeat them, so work on institution, work on innovation, sustainable infrastructure, integration and trade, I find that extremely interesting, also because you call them as a lesson to get out of the middle income trap. But in reality, last week we were issuing on our side the EIB, our investment report for Europe, and we come out with a very similar message for Europe overall. So it may be related to the middle income trap, but I think it's also related to good economic, competitive, sustainable economic growth overall. So the messages are very much interesting, and I fully share them. I wanted to mention a couple of things, and also referring actually to things that we have been studying and looking at specifically. On the one side, I think you talk a lot about institutions. At the very end, you were talking about regulation, and I think we get back to liberalize, etc., liberalize market and regulation. One thing that we were looking at is that the impact of regulation on European firms, it looked at as it's not only having a negative impact. So it's not only when you ask firms and they say they limit investment because of a regulatory burden, because of labor market regulation, etc., which is quite relevant, but also for the many indirect effects and the distorting incentive, misallocation resources. It's very strong, the impact that it has of misallocation of resources, the impact of labor market regulation in particular. And then also the capacity of firms to deal with uncertainty. When you are more regulated, you are less reactive to change, and in a situation of uncertainty like the one that we have seen in the last years, firms are much less able to act because the uncertainty blocks them much more if they are very much regulated, because they know that they wouldn't be able to adjust in the future. And the other thing is that regulation is also blocking very much innovation. And what we want is real innovation. So in a number of things, I think much more looking at regulation issues, liberalization, etc., having in mind not only the direct effect that they have, but also this indirect effect passing through the wrong incentive in allocation of resources, capacity to deal with uncertainty, and the constraint they have on innovation. A second point I wanted to mention, and it's very much related to what you were pointing out, I think we all have to work much more on labor market skills, but skills. We run a survey interviewing every year 12,500 firms in Europe. That is called the IB Enterprise Surveys. Together we are doing the enterprise surveys for the region, for MENA, for the East, etc. In our survey, the one on Europe, comes out that 72% of European firms say that availability of skill is their major impediment. It's true in Germany, in the countries close to potential, etc. It's completely true all over the region, and all over the region has to do with the outward migration, etc. But it's very difficult to understand what can firms, countries do. In an integrated market, you train more your people, and if the people are going away, it's not your incentive to train them. Maybe you have to pay them more, and maybe we are not even we are not yet, despite of the very fast increase in wages, we are not really remunerating yet the productivity. Or there may be other issues that we still don't understand in the market. But I think it's something that, particularly for Central Eastern Europe, it has to be analyzed much more to understand what kind of policy message can be done in the context of an integrated EU market, because that is the challenge to look at. In terms of innovation, again, is one of the important point that you are looking at. We are concerned on two different things. On the one side, the fact that on a policy point of view, a lot of the incentive that are going toward innovation, in reality are incentive going to R&D only and not to other form of intangible. And it's very difficult if you wanted to design a policy that targets other form of intangible, how to really do it and how you consider to incentivize training, how you define it, etc. I think much more has to be done, and institutions like us are the ones that can probably in an easy way, try to enlarge the incentive schemes in that point of view. And the second point related to innovation, I think is we have done a lot of work on the how firms finance different kind of assets, and then financing different kind of assets, you look at intangible and obviously the link with innovation, etc. And you really see the need of diversified financial sector to support the financing of innovation, de facto, of assets that are conducive to innovation. And here it's something more, maybe you have worked a lot on that. The transition report doesn't have much about the diversification of form of finance, etc. And for the region, I think is an extremely important thing to tackle. The last point on infrastructure, and this is, again, I think it's extremely important that the region continue to work on optimizing their infrastructure, structure, whatever. But there are, I think, two things to note. And here I talk mostly of Central Europe and Southeastern Europe. I think we have to consider the MFF discussion at the European level. The region has the resources now. There is a lot of discussion, and maybe Lucia will talk later about that, on how to modify the allocation of funds, how much grants, how much financial instruments, also to support infrastructure, etc. But and the pie is, the discussion on how to divide the pie is tough, and it will go on going forward. But the point that I have is that the region seems to be very much addicted to grants, if you can call it. And I think this addiction to grants has to change and think about a new way of really using in an effective way the resources. And on that point, I want to mention something also that is coming out from our report is a little bit less true for Central Eastern Europe, but I was shocked of these figures. We were doing part of the survey is a survey of 600 municipalities in Europe, and we were asking the decision-making process that brings to the adoption of a new infrastructure project. What comes out is that only 40% of municipalities do an effective ex-ante assessment, a social economic assessment of the project, which is binding for the investment decision. Maybe 80% do it, just 40% of the time they don't care about it. And the point is that quality of infrastructure is important. And here it comes the role of institutions like us that actually are also granting quality. When projects pass through us, there is a quality control of the projects. And I think that the region has to have a lot of quality. I was saying it's a little bit better than the rest of Europe, surprisingly, Central Eastern Europe, but the fact that they get a lot of co-financing through us and a lot of EU financing, etc., this seems to be better than other European countries that are the old core that are doing a little bit less. The last point, but I basically finished, but one point that was mentioned in a couple of by you and also repeated, size matters in the region, definitely true. Look also at ownership, because we have been looking, again, through our survey, looking at the behavior in Central Eastern Europe of firms that are foreign or domestic owned. It's massive. The foreign owned have a much better stock of asset, quality of assets. They have much more investing in new technology, much more innovating, etc. So it's not only a matter of size. I think the real driver it's the ownership and managerial, and you have done a lot of work on that. So just to look more in that direction.
Deborah, thank you very much indeed. Lucio.
Many thanks for that, John. I'll start by thanking the invitation to be here and the fact of being here among all the friends, Sergei, Solt, and Deborah. I look forward to the continuing evolution of the report to eventually be called the convergence report.
Accomplished convergence.
Absolutely, assuming that transition ends up as we all assume that we will do one day. I will take an unashamedly European Union view on my comments, and I will structure them around, as implicitly my colleagues did, along the four axes of your concluding policy recommendations. I would also like to say that we are deeply appreciative of the Commission as the diversity of tools that we have to deliver convergence among our member states, and we see both the EIB and the EBRD as part of this universe of choices that enable us to maximize the effect of our actions. This said, let me structure this along the 4 axes of your policy recommendations. And the implicit point that I will try to make, to try to link what you are presenting us with what amounts to a policy-relevant set of recommendations to a policymaker that is sitting at the European Commission. Right? So I will zoom in this towards the specific questions that faces countries which are members of the European Union. You will structure your recommendations among 4 different axes, namely innovation, integration, institutions, and infrastructure. I will start by the first one, which I think is the easiest one. The Union is an integration machine. The great shield that we have from external shocks is, among other things, our beloved common market. We can make an analysis that shows that integration, if you measure this, for instance, in terms of global value chains, survived much more for countries that were members of the European Union than countries that were outside of that. More than that, you can actually make a case that the countries which are on the remit of the EBRD were the great beneficiaries of the GVC process of integration that we had within the Union. You can actually show that we have a reduction of the amount of GVC-based integration for countries which are on the northern part of the Union, the UK being the one that lost more, towards what we can call the industrial core of the Union, which is Germany and the Eastern European countries immediately to its borders. So I think that in terms of integration as a driver of convergence, we are delivering there, essentially on the more traditional manufacturing sectors, but not necessarily in areas like services. Is there something that we could think that could be improved in terms of our package beyond what we are doing in terms of the digital single markets, the energy union, etc., that could make the European Union single market an even more powerful engine for convergence? On the innovation part, and I would refer here to my previous remark about the value of diversity in terms of the instrument through which we deliver our policies for the member states. We have several different types of instruments through which we try to support innovation at the level of the member states. They go from traditional grant providing type of instruments, think of a Horizon 2020 type of a framework, to something which is more entrepreneurially based, namely, as an example here, the UVAC, which is a support for VC-based type of support of innovation, which we are doing on a more market-basic centric type of a framework as opposed to relying on individual institutions. Now, is there something there that we could be modifying that would be more adapted to the type of, let's say, ecosystem that you find in Eastern European countries? On the institutional basis, the Union is a governance building machine. We know that from the very beginning. I know that from my very own country and the experiences that we had on entering the European Union. I am a proud Portuguese citizen, as was highlighted before. I'm sure that Deborah is also a proud Italian citizen, by the way. Now, we all have our burdens to carry, right? Now, on an institution basis, we all are faced with the reality that we had two large blunt instruments to deliver governance change, let's put them in those terms. One is European Union accession, the other was Euro area accession. Now, within the intertwining period between those two life-changing events on the life of a country, we are faced with a more constrained type of set of tools to support and incentivize governance change behavior at the level of the member states. We are playing around with things that we can do with the European semester, supporting with different types of funds. Is there something there that we could be thinking that would be more specific for Eastern European countries? And I will link that actually with the discussions concerning the MFF. I will also mention that in relation to the infrastructure part. I think that we have made significant advances in terms of the recovery of the overall level of investment in the Union to pre-crisis level. If there is a gap, it tends to be not on private sector driven instruments or levels of investment, but more on government supported instruments. There, as Deborah just indicated, we have an unusually large level of dependence of Eastern European countries on effectively grant mechanisms from the union side, cohesion and structural funds, to maintain their levels of investment. Now, we are having all sorts of discussions about things that may or may not happen in terms of the next multi-annual financial framework, so the European Union budget, that go to certain types of instruments that could be used to support the convergence in terms of governance at the level of member states. They could or cannot in some point to be linked to the framework of the European semester. We are toying around with potential scenarios on how we can change the way that we deliver structural funds. Are we going to be linking them to something that will be something like performance-related types of indicators? Are we going to make those instruments more competitive-based? This is still a very much ongoing discussions, and policy advice and dialogue with us during this discussion process is very much appreciated and enables you to have, you as institutions, to be a voice in terms of the debate. I will finish my comments here, and I hope that they were useful in terms of your own internal reflection.
Commissioner, that was very interesting. Thank you very much indeed. So we've heard three different views on that. Before we take some audience questions, before I use my microphone, Sergey, just a very brief reflection on what you've heard.
Thank you very much. I think all these comments were very useful. Indeed, let me briefly reflect on this. I fully take Zsolt's point on diversity. And we are in Europe, so we are talking about diversity between Croatia and Poland, but we also have Morocco, Mongolia, Egypt, and Jordan, which are, of course, even more different. But indeed, the question is why some countries suffered more during the recession, some less. And some countries actually chose to maintain the peg to euro, which prolonged the recession, because they thought that joining euro area is more important than 4 more years of recession. So these are issues sometimes not just fate, but actually conscious policy. And I'm happy to talk about specific countries, but I guess it will take too much time. On TFP measurement, I fully agree. And I think cyclical decline of TFP is also a decline in TFP, which is to be addressed. But indeed, it needs different measures than promotion of long-term TFP growth, which needs investment. On Washington Consensus, we think that indeed Washington Consensus, as perceived by many, is too unidimensional. And that's why we introduced those 6 dimensions of sustainable market economy. But actually, if you read Washington Consensus, it is 10-dimensional, and it does include many of those measures. It does talk about targeted social safety nets. It does talk about broadening tax base. It does talk about institutions, property rights, and so on. So it's not as simple, just liberalize, 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 as some critics want it to be. So in that sense, I think it does deserve some credit. On open versus close, I agree that some options available to China are not available to our countries. If you're a small country in Central Europe, there is no chance you can grow if you close up. You need to be integrated. What we show, and what Lucio just said correctly, and what you know very well, is these countries manage to benefit from opportunities created by globalization. We are very happy about this. On capital account, openness or closure. The problem there is, of course, that you close capital account, but if country is corrupt, there is always a way around. So you create rents that are then concentrated in some parts of the society, which are not necessarily the most meritocratic parts of the society. Let's put it this way. And that's why we actually are happy when countries at least remove the black markets. And that creates an opportunity for our business as well. If a country has multiple exchange rates, it's very hard for us to do business with this country because we cannot predict at which rate our clients will be able to buy currency to buy equipment from advanced economies, right? And that's a major challenge. When we talk about pricing of our loans, 1 percentage point here, 1 percentage point there, and then the gap between multiple exchange rates is 20 percentage points, 50 percentage points, it's a completely different universe. Just to give you an example, Uzbekistan just liberalized exchange rates. Turns out that inflation didn't go up. Why? Because retail prices were already based on black market rates. Just to give you an example that sometimes capital controls don't fully function. But overall, I think it is a challenge, and you're right that capital controls may reduce volatility. But in some countries, you need more than just capital controls. And this is our advice on resilience. And we work a lot with countries to promote capital markets, which would be deeper, capital markets and banking systems which work in local currency, which also increases resilience. And I fully agree with you. On labor markets and demographics, again, I fully agree with you. And actually, our next transition report will be exactly on labor markets and demographics. And we think that governance is a bigger issue, but still we think that labor markets and demographics are so big that we cannot avoid talking about this next year. So we'll look at immigration. And indeed, as you rightly said, region is so diverse that in some regions we have something like Central Eastern challenge, when skilled immigration and aging is a big problem. In some regions we have youth bulge, where you have many young people coming to the labor market and looking for jobs. So it's going to be an interesting intellectual challenge. On Eichengreen's recommendations on education, it's indeed a very difficult thing to do. And indeed, in some of our countries facing this challenge, government officials actually look at building schools, universities, I mean. So, for example, Baltic states want to excel in fintech. And I was talking to a former Minister of Education who also was a former Minister of Economy, and he now is running a think tank. The job of this think tank is to restart growth, and he says we need to build a university to produce, 3,000 software engineers a year. And now we produce 300. So it's a very specific thing he's thinking about, but exactly along the lines you mentioned. So on Deborah's point about role of regulation, I fully agree that some regulations issued by this commission actually open up markets. And as I said, size matters. Being able to grow matters. And sometimes by removing barriers between nation states, of course, commission actually creates markets and creates opportunities for innovation and growth. And I think this is something that, especially in our place in London, not everybody thinks commission enough for what it deserves. On the issue of diverse financing of innovation, I fully agree with Deborah. Banks are not the best channel for funding innovation. And of course, this is where equity financing is so important. And 2 transition reports ago, we looked exactly into this issue. And we keep talking about this here. And I skipped a slide on how equity is important for financing green innovation. Because again, if you think about a bank gives a loan for 5 years. In 5 years, green policies will not be universal. But if you're an equity investor, long-term investor, you know that in 20 years, some assets will be stranded. So you don't invest in non-green assets. And in that sense, equity is very important. And equity links into institutions and governance, because for equity markets to work well, you have to have good national governance and good corporate governance. Now, on infrastructure, and that links to Lucio's comment as well, we, of course, are a private sector bank, and we believe that we need to engage and crowd in private investment in infrastructure. I didn't have time to talk about this. We actually have a box in the report studying our own experience in private-public partnerships, and actually a big annex talking about global best practices. And I think this is the future. We need too much innovation for public budgets to fund. And we have quite a bit of experience, and we think that a lot more can be done in crowding in private money for innovation. Finally, about Lucio's 4 I's, innovation, integration, institutions, and infrastructure. I should say you're not the first one. Advisors to then-President Medvedev in Russia also advised him on 4 I's, which were different.
I imagine that they were more intrusive I's, right?
Yeah, interestingly, there was no invasion or intrusion or whatever. There was innovation, investment institutions and infrastructure. You said innovation, integration institutions and infrastructure. And the fact that Russia is not integrated enough today probably also reflects lack of prioritization of integration. Now, some other advisors to that president also said that should be 5 eyes and added intellect. And I think that also emphasizes the lack of understanding that innovations come from intellect. So, but anyway, I think you mentioned one very important thing about moving towards VC-backed funding of innovation. We are also very much excited about this. We co-invest with pretty much every good private equity firm in the region. We invest in more than 100 VC firms, and this is where we actually see huge impact on funding innovation. And I think, again, crowding in private investment is the best thing because you cannot replace the market. And again, coming from Russia, I can tell you every large company and every state-owned large company has a program for innovation development. And this is called forcing to innovate. That was, again, President Medvedev's words. You need to force big companies to innovate. We can see the outcomes. I think without integration, without markets, you cannot really hope for this. And we need to crowd in private investment rather than hope that governments can decide how to bring in innovation. I'll stop here.
Sergey, thank you. We will take a couple of quick questions if there are some. And if you could say who you are, that would be fantastic as well. Okay, yes, gentleman here. There's a microphone coming towards you.
I have 3 comments. One is very technical. I would be happy to see who's a characteristic in terms of demography, in terms of natural resources endowment. Is one thing. Second is, despite your presentation, I still don't understand what really middle income trap is. So everybody, well, not maybe everybody, but many people like to use this term, but as I think, very misleading. And basically, if you look for economic history, it's not so many successful cases of rapid catch-up, and Korea, which you mentioned, is one of few of them in 20th century, or second half of 20th century and beginning of 21st century. So basically, it's very well known that with progress of catching up, the speed of the pace of catching up is becoming slower. And then you have plenty of examples of stocking at some income level, not only in a middle income level. You have, probably a few tenths of low income countries, especially in Africa, which are stock on a very low income level. You have, case of Western Europe, which hoped 30 years ago to catch up with United States. It never happened. So I'm not sure that it's useful. It's perhaps useful in, some journalist, political, ideological discussion, but not necessarily academic debate. By the way, Washington consensus, which was mentioned here, is the same kind of concept, I would say, which also, apart from one paper of John Williamson, never well defined, but very favorite topic of polemics. So instead, I would like to see, and before going to more sophisticated explanation of growth slowdown and this negative TFP trend, I would like to first to see what is the impact of demography, what Zsolt mentioned and you, Sergey, acknowledge. I think this goes beyond the labor force, this impact distribution of GDP, political economy, probably also TFP, investment, etc. Second thing is the impact of the collapse in decline in oil and commodity prices since 2014, given the role of Russia, Kazakhstan, and few other countries in this EBRD aggregate. I think that it may have impact, especially of TFP, which is residual, and deterioration of terms of trade has impact here. And third thing is, I think, more traditional EBRD approach, what is impact on governance on this. You presented a quite optimistic picture that is now we have more reforms than anti-reform, but I am not so much sure, especially looking for some key countries like Russia and no, but also I think several Central European countries, also in Central Asia. I am not so much sure that we have here a lot of progress, and this would be also important to try to find out what is the impact on this growth and TFP slowdown or negative TFP.
Okay, thanks. Very diplomatic view not to name some Central Europeans. We can take one quick question as well, and then I'll get Sergey to answer if there's another swift question. There's a lady at the back on the right-hand side, yes.
Just a very, very short one. First of all, thank you very much for this presentation, for the event. And secondly, I would like to support the idea about the demography. I myself, I'm coming from the University of Latvia, that is Latvia, the Baltic state that were mentioned a couple of times. For us, it is extremely essential issue. And in fact, the education matters, obviously. However, we speak about rather consolidation of resources to provide intellect and go to innovation. And in this respect, and in relation to the labor market, my question is about the digital economy. Since the European Union is moving very fast, well, as fast as they could, to the digitalization. So the question would be, how it would link to the labor market, and if it's not reflected in this report, would you consider it in the future reports? Thank you very much.
Okay, and I'll take one very quick question from the gentleman just here. We'll bring a microphone, and then Sergey, you'll have about 3 minutes to give your answer. So,
Plasker, University of Leuven. My question is a very large one and yet a very simple one. Okay, when you speak about countries that are less evolved, less developed, one thinks about, of course, agriculture. I didn't hear much about it. My question is, what about, in general, of course, agriculture? Because there are some countries where it's very important, of course, Poland, Romania, Russia, etc. Are they able to feed their own population? I mean, it's basically that.
The agri-sector, right. Sergey, you have 3 minutes, 45 seconds.
Thank you very much. These are all good questions. Mark's technical question about what are the comparators. As I said, we base comparators on GDP per capita and size. Don't look into structure of the economy, natural resources, and demographics, which of course is a disadvantage. I agree with you, but there are only so many countries in the world. But yes, it is a problem. But if you think about this, throughout 38 countries and territories that we work in, that things kind of washes out. On middle income trap, I fully agree with you. There are countries which are stuck in low income trap and high income trap, like West European countries. Some people would say Western Europe is actually not doing badly if you take into account life satisfaction and leisure. But overall, I think it is indeed a conceptual thing rather than econometric thing. And indeed, it is useful to think about changing institutions. So for example, for debt-financed capital investment with collateral, you need banking system, and that's one set of institutions. For venture capital, early stage financing, innovation, you need some other set of institutions. And for example, China now needs to think how they build with their legal system and their financial system, innovation-driven growth model. And it's not going to be easy. So this is what I meant by middle income trap. But you're right, it is not a well-defined concept. Unlike Washington Consensus, where there is a paper, which you mentioned by Williamson, and there is a 10 bullet points, so 10 item list. On impact of demographics, I agree. It goes beyond labor supply, political economy, also innovation. So Simeon Dyankov always says that older people are less likely to innovate. And that's why we don't have young people here. They're all out innovating. Right? And that's normal. Younger people have more time in front of them. They have less knowledge of how risky things are, so they're risk-loving. So maybe they can innovate better. Impact of oil prices, we actually look at this in macroeconomic supplement, probably last year rather than this year. On impact of governance, it's very hard to measure it well. I fully agree with you. But overall in our region, I think in broad terms, you can think about countries which completed democratic transition, more or less built function democracy, consolidated democracy. These are also the countries with good market institutions. And then you also have countries which have failed to complete democratic transition, don't have democratic system. And here I'm not going to name any single country, but these are the countries which have kleptocratic capitalism. And indeed, there are these big issues about quality of governance and economic institutions. And on more reforms or less reforms, we have colleagues in the banks which promote reforms, and we need to measure their performance. And it's not like we are going to give a score for moving from non-democracy to democracy. We're saying you have a better system of incentives in government bureaucracy. Check. We have built a foreign investor council. Check. So when I say a reform, of course, it is something that is statistically significant from zero and has a positive impact, we believe, but it's not necessarily transition from dictatorship to democracy. On digital economy, EU is moving fast, but it started late, probably 15 years late. And I think it is crucial to build a single market in digital goods and services, because especially in digital sector, you need scale. So Europe is a big marketplace, and you need to make sure it's a single market in digital. Otherwise, Europe will always be in the backseat relative to US and China, as it currently is. I should say that I'm a part of World Economic Forum's Council on Human-Centric Economy, led by actually Deputy Prime Minister from Brussels, from Belgium. And we talk exactly about these issues, how digitalization can actually be inclusive and provide jobs rather than destroy jobs. On agriculture, I should say that this is a very good question, and for many of our countries, food security is a big issue. And we still don't know how to measure it well. I mean, the food security at the country level, having comparable indicators. And so we are working on this, and unfortunately, I don't have a good answer for the moment. I should, but I don't. Thank you.
Sergey, thank you for that candor. Thank you, Sergey. Thank you, Lucia. Thank you very much, Deborah. Thank you, Zsolt. And thank you to all of you. A big thank you as well, by the way, to Bruegel for hosting this for us again this year. It's always great to be here. And of course, you can find out more about the transition report, either in the hard copies we've got, but actually even richer material online. So please have a look at the transition report online. There's a lot more there as well than there is in the physical document. Thank you very much.